So guys, in this video, I'm going to be answering some of the really great questions that I've been getting from all of you lately. Starting with this question here from my friend Sotiris, who wants to know, where do I start with researching stocks, and how do I know if I have done enough research on a company? Do you think that going through the investor presentation, the annual report, the company's website, and a few metrics and stats for the company would be enough? So when it comes to researching stocks, especially as a brand new dividend investor, the three most important questions I think that you'll want to answer are: number one, do I understand the company? Number two, is the company growing? And number three, is the dividend safe? Now, I think all of those things that you listed out there are a really great place to start when trying to answer those questions. And I think that if you just do those few things, then you'll already be putting in more work than many other investors out there. I really like investor presentations, especially as a step numero uno when trying to learn about a company, because they give you a lot of high-level information about the company, how it operates, and some of the numbers behind it. And it's usually presented in a pretty easy to understand way, which makes it perfect if you're just getting started. Now, from there, annual reports and the quarterly earnings calls are a great next step. These are typically a bit less beginner-friendly at first, but I do think they're definitely worth the effort because they give you a deeper look inside the company and allow you to learn more about it directly from the management team, straight from the horse's mouth. Now, when it comes to gauging the company growth and the dividend safety, there are a lot of great resources out there. I mean, you can get that information just by looking at the company's SEC filings. But I personally prefer to use a tool like Snapstock that shows you a decade's worth of financial trends in one place. And there are a ton of other great platforms out there that do something similar, like Seeking Alpha. I think that's another one worth looking into, or Simply Safe Dividends. That's also a very solid platform. But either way, I would recommend investing in some sort of tool like that that will present all of that financial data for you in one place. It's just going to make your life a whole lot easier when doing your stock research. Now, with that said, the more reps you get looking at different businesses, the more your process will naturally grow and evolve. You'll figure out the things that matter to you, the things that don't, and you'll come to develop your own method to the madness. You know, like anything else, it just takes practice. Now, as far as knowing when you've done enough research, that part's a bit harder to define. I think that's where investing becomes part art and part science. In my experience, I don't think you'll ever feel 100% certain about an investment because things can always go differently than how you plan. But if you've done the work to understand how the business makes money and you feel good about its long-term growth trajectory, then those are some pretty good signs that you might be ready to pull the trigger. And if after doing all of that work and doing all of that research, you're still unsure, then the answer is probably no. It's a stock that you probably should pass on, at least for now. But anyway, guys, now moving on to question number 2. This one comes from Jake, who says, from your experience, what excuses are most used by people not to invest? And man, this could honestly be an entire video on its own, but if I had to narrow it down, a couple of things stand out to me. First, I think there's just a lack of awareness. You know, a lot of people don't even know what stocks are, and think of the stock market just as a bunch of numbers on a screen that randomly move up and down with no real rhyme or reason to it. And admittedly, as I'm sure we've all experienced before, it can be like that sometimes, but a lot of people don't realize, like I said, what stocks are. They don't realize that stocks represent ownership in these living, breathing businesses, actual companies. The people who don't realize that are hesitant to put their money into something they don't fully understand, which is understandable. When something feels so abstract and unpredictable, it's easier to write it off as something not to take part in. But anyway, the second reason that I think a lot of people don't start investing is simply because they have other things they would rather spend their money on, which should come as no surprise. Investing seems boring to so many people, especially young people who, unbeknownst to them, would benefit the most from starting to invest at their age. And for these same people, retirement feels like it's a lifetime away, so setting aside money for it doesn't really feel that urgent. And because it's not urgent, and because the benefits of investing only become tangible with time, it's easy to prioritize spending money on things that will pacify the present you in the short term over the quote-unquote boring assets that your future self is begging you to buy. With that said too, investing is one of those things that everybody has to start doing at some point in their lives. And unfortunately, a lot of people don't get started as early as they should, myself included. I was 26 years old when I started investing, but I wish if I could go back in time, I would have started when I was like 12. And I wish I knew the best way to convince people to start investing, but I really don't. It's like pulling teeth. And I think people will only start investing when they feel ready to, which for a lot of people is when they realize that they can't put it off any longer. Maybe I'm wrong about that, but I figure the best thing I can do, and really the best thing any of us can do, is just lead by example. Make yourself the test dummy and show people what's possible if you just get started and build your portfolio one brick at a time. I want to hear from you guys though. Do you have any tips on how to convince people to start investing? If you do, drop them in the comments. I think we could all use some good insight on that. Anyway, guys, now moving on to the third question of the day. This one comes from Steven, who wants to know, I was wondering if I found a good opportunity in Stanley Black & Decker, ticker symbol SWK. The share price has been dropping and might drop some more, but they seem to have great dividend characteristics. And to be honest, I'm pretty torn on Stanley Black & Decker. I mean, looking at the stats over here on Snapstock, you're right. The dividend stats are looking pretty juicy. At today's prices, you can lock in about a 5% yield, which is way above the company's 5-year average yield of about 3%. And you'd also be buying a dividend king with 56 straight years of dividend increases, which is very impressive. And the average growth rate really isn't too bad either, about 4%, which is not bad at all considering how high the starting yield is. I think these are pretty solid dividend stats. But I will say, beyond what's going on here, not much else about this company really jumps out to me. If we look at the Snap score, we can see that the company is getting some very low scores. Overall, it's a 2.2 out of 10, so definitely a below average company. If we look at the breakdown of these scores here, their highest score is coming in the dividends and buyback section, which is only a 5 out of 10, so that's not great. Getting more into some of the company's growth metrics, which if we go back and look at this was a 1 out of 10, revenue has more or less flattened out over the last few years, and as we can see is now starting to dip. And that's not necessarily a deal breaker on its own, but when you pair it with the significant drop that we're seeing in the earnings per share and also in the free cash flow per share, I do think it becomes a bit of a red flag. Going back down to the dividend stats though, the good news is that the free cash flow still covers the dividend. It looks like in the trailing 12 months, their free cash flow payout ratio was about 64.5%, so still room there. But the net income does not cover the dividend. The earnings payout ratio was about 140%, so they're paying out more in dividends than they're generating in net income. And although I do care more about the free cash flow payout ratio than the earnings payout ratio, I'd still rather see both metrics in a better spot. So overall, even though the dividend stats look pretty good on paper, I think the negative things we're seeing in the financials, at least in my mind, outweigh the good things that we're seeing over in the dividend department. Personally, I'd rather go with a business that is looking better under the hood, even if that means it's coming with a lower starting yield. I think it's more important to have solid financials and fundamentals. So having said that, I will be passing on Stanley Black & Decker. Now moving on, guys, to question number 4, which comes from Wyatt. Wyatt says, I'm doing a riskier strategy, LOL, and I'm investing in high dividend ETFs. Uh-oh. He says, my main one is QQQY. Being a young kid and not having a lot of money in my portfolio, it attracted me the most. I feel like since I don't have a lot of money and I'm just starting off, I need to invest in some higher yielding ones. I know the higher yielding ones are normally not very safe or reliable, but what are your thoughts? So if I'm being completely honest, Wyatt, because you are so young and have so much time on your side, that is your greatest advantage. Because you have that working for you, I don't think you need to be reaching for gains or reaching for dividend income right out of the gate through these riskier, more complicated ETFs like QQQY. These type of funds might seem tempting because of their ridiculously high yields. I mean, QQQY's yield is sitting at about 80% according to Seeking Alpha, but they're a lot more complicated and flimsy than they look, and I don't think they're a good place for a bright young investor like yourself to park your money. I mean, you even hinted at it in your question. You know these aren't very safe or reliable, and based on the way that you phrase it, I think you know that these yields are pretty much too good to be true. At the end of the day, if you don't fully trust where you're putting your money, I think that's a pretty great sign that you shouldn't be putting it there in the first place. As a beginner, Wyatt, I'd really encourage you to keep things simple and just focus on building a better foundation. I think you want the bulk of your portfolio in something more straightforward, like solid, diversified ETFs that simply invest in great companies. You don't need these derivatives, and it's not as flashy as a 80-something% yield, but it's effective. And that's not to say that you can't own any of these high-yielding investments at all. I mean, you're young enough, you can take some risks. I wouldn't make it the main focus in your portfolio, if that makes sense. I think maybe just sprinkle it in, make it a small piece if you want to have some fun and try it out, but definitely don't make it your bread and butter. But anyway, guys, now moving on to our fifth question of the day. This one comes from Zachary. This is a great question. Ryne, do you think you'll hit $125,000 this year? And man, I sure hope so, but it really depends on a few things. So first and foremost, it comes down to my contributions. And right now I'm investing about $1,000 every single month, give or take. And so with about 7 months left here in 2025, just my contributions alone, not counting any potential capital gains or the dividend income that I have yet to receive, just for my contributions, that should put me just over $100,000. And on the dividend side of things, I'll probably pull in another $2,300 to $2,400 by the end of the year if I had to guess, which would bump me up to about $103,000, $104,000, which definitely helps, but it still leaves about a $20,000 gap to hit that 125K, which won't be easy to fill. I guess it's still possible to get there if the market just completely soars the rest of the year, but I'm not banking on that. I'd be very surprised if by the end of 2025, I saw another 20% gain in my portfolio from here until then. So having said that, getting to 125K would mean being a lot more aggressive with my contributions. I think that's really what it would take. And normally I'd be all for that, but right now I'm really trying to stash all my extra cash in a high yield savings account, which I'm hoping to eventually use to buy more real estate. So because of that, I'm not planning on adding anything additional to my portfolio the rest of the year beyond just what I'm already contributing. So we'll see what happens. My real goal, my main goal is to get to $100,000, and I see a pretty clear path to get there. And so in my mind, anything above that $100,000 mark is just bonus points in my book. And with that said, guys, in this next video right over here, I'm actually showing you my entire dividend stock portfolio and where it's at right now. In this one, we'll get into every single one of my holdings, including the number of shares, the gain and loss with each position, as well as the dividend income that I've received so far. So click right over here to check all that out, and I'll see you in the next one.